let's move on to the next paper in the session, titled Using Equity Index and Commodity Options to Obtain Forward-Looking Betas and Conditional-capm Expected Crude Oil Spot Prices by Ehud, Ronn, Baum, and Paola Zerilli, and Ehud is presenting.
Okay. Well, good morning again, ladies and gentlemen. I'd like to, before I begin, thank Andrea for organizing this session, Jerome for chairing it, and the organizers of the conference for inviting the paper. I'd also like to express my thanks to the British Airways Corporation for hopefully delivering my luggage later today.
My question too.
And others. Permit me to describe a little bit the paper that my co-authors and I have been working on, which I'd like to present to you. So what we're trying to do here is use the Conditional-capm to forecast spot prices. And what we'd like to do eventually, and we're only laying this out initially or the outset here, is to use only forward-looking indicators to forecast this measure. And so essentially what this is a search for is a forward-looking measure of beta. And so I'd like to talk a little bit about where the literature has gone and see what it is we're trying to contribute in terms of the methodology of obtaining a forward-looking betas. As you know, most betas that we use are historical with different moving windows on the past, and we are doing that as well, but that's en route to what will hopefully be a purely forward-looking beta that we'd like to use. En route, I'd like to address something that was raised yesterday in a lot of settings, and that is this issue of what some have termed a financialization of oil markets. And I think that the very terms that we use, the semantics that we use, are indicative of what our priors are on this matter. Because when you use the term financialization, there's a presumption of a pejorative there. There's something bad about these people in New York or London or elsewhere maneuvering and manipulating markets. Notice that if you change that to the term integrated capital markets, now what was heretofore pejorative becomes a benign, in fact, an expected outcome. And so I think that's one of the things I'd like to talk along the way is show some evidence that markets are not just being whipsawed by these folks trading in New York, London, or elsewhere. So in terms of the forward-looking parameters that we'd like to extract, one of the things I'd like to talk about is the issue of a term structure of implied betas for equities. That at least potentially has something to say beyond just energy, and that is the issue of can we extract a term structure of implied betas and what implications that might have for capital budgeting decisions by corporate finance people. And then the issue of calibrating 1- and 2-factor models of the implied correlation term structure for the crude oil futures contract. We'd like to talk about that as well as I present the model to you. Since I have a little bit of time, let me talk about whence the literature has come in terms of at least the issue of implied parameters. So as I laid out, I'd like to present the issue of implied volatility, correlation, and implied betas. That, of course, goes back to the historic paper, I guess historic is the right term, by Latine and Rendelman back in the 70s on implied volatility. There's a number of folks who have looked at implied correlation. Siegel and Margrave have looked at that. And more recently, there's been a number of papers, this is one of the important ones, on looking at option implied volatility and skewness measures. And so CCJV, if I may call them that, have this relationship over here that looks at the skewness and variance in the option markets to extract an implied beta. And so just to recap, the reason the implied beta is important to us here is that we'd like to have an instantaneous forward-looking beta rather than a moving window beta that uses historical prices. There's been a couple of folks who have looked at the CAPM in terms of crude oil futures contracts. So you've got Fouquet et al. On continuous time CAPM, and Rita de Clesia and al. On time-varying correlations. A number of people have noticed that these correlations have recently, and by that I mean the last 7-8 years, have moved from where they were in the earlier period. So I'd like to cite those as well. By way of motivation, ladies and gentlemen, I'd like to present to you the following. And some of these ticker symbols that I'll use are Bloomberg ones, so they're the ones where we extract the data. And so what we're looking at here is the S&P 500 in terms of the equity market representation. And CL1 is the prompt month futures contract for oil, the one that is indeed traded at Cushing, as Sebastian said. So what I'd like to show you here, is no, all right, we'll do it the old-fashioned way. It's all right. It's all right. I'll do it the old-fashioned way. What you see before you here is a moving window correlation between the prompt month contract on crude and the S&P 500. The window itself is of length 45 days, and of course we're looking at rates of return on both of these instruments. And so what you can see is essentially what happened during and in the aftermath of the Great Recession. You had this very strong positive relationship between the prompt month contract of oil prices and the S&P. And essentially, if you remember that period, you had on-risk days and off-risk days. In off-risk days, the sun was shining and everything was glorious, and so both prices moved up as the recovery began. In on-risk days, the apocalypse was here and both of them fell. And so you had this very strong positive correlation over here, which, as I said, a number of people have noticed, until you hit the spring of 2011. And that's when it turned negative. And of course, you can see the sharp change, and it turned negative because what happened in the spring of 2011? Not that long ago. The word spring should be an indication. The Arab Spring. So the point is, I guess I shouldn't wander around. The point is that the market is sensitive to supply side and demand side shocks. So long as the demand side shock was in control, you had this positive correlation. When you had this geopolitical shock that came in, it turned strongly negative as prices rallied and the S&P fell. And just by way of a little bit of historical context, this wasn't so much because of oil coming to us from North Africa. Libya does not produce that much, Egypt even less. They were never big factors. The real concern was
Saudi Arabia.
Contagion to the Persian Gulf. That was the concern that the markets were concerned with. And then when it appeared that there would not be contagion, we went back to the positive correlation. We went back to worrying about whether the recovery was in place. So the point is that markets do show reasonable sensitivity to things they should be sensitive about, which is what is happening there in terms of supply and demand shocks. And so if you apply the CAPM, I know it's a simple single factor model, the point is that what you get is this simple relationship between the expected rate of return, the correlation between the asset and the market, its implied volatility, and some measure of the equity Sharpe ratio. And then if you take this equation 1 then and plug it in, you're going to get this result over here, that the annualized expected futures price change is proportional to the correlation to which I alluded, the implied volatility, and the Sharpe ratio. And that's really the motivator for the work, is to see whether by parallel to the implied volatility here, which is a forward-looking measure, can we get a forward-looking measure of the correlation, which allows us to explain these kinds of things? And the beauty, if we're able to succeed in doing so, is when you get a forward-looking correlation, you will instantaneously be able to see whether the market is concerned about demand-side shocks or supply-side shocks. So that's sort of the motivator for why we're interested in a forward-looking measure. And the other nice thing that, or the implication of the model is, when you have a supply-side shock, to some extent, futures prices are too high. That's what the literature, the lay literature, refers to as a risk premium, right? Prices are elevated because we're concerned about the availability of supply to demand markets. And so you can see that that is the time when you get a positive difference between the futures price and the expected price. In a demand-side situation, when the correlation is positive, you should get the other way around, right? You should get that futures prices are below the expected prices as you get the risk premium going in that direction. So I think the importance of at least trying to get a forward-looking correlation is to address this issue of when does the risk premium switch signs. So that's sort of the idea. And what I'd like to do, since with Jerome's permission I have a little bit more time, I'd like to give you some ex post evidence in support of this notion that the correlation is important in terms of the sign of the expected risk premium. And I'd like to do so in two ways. So what I'm showing you here is the result of a simple regression of the rates of return on the futures contract on the stock market, and then I reiterate the risk premium issue. So the point is that if you divide by the implied volatility, you get something that is proportional to the correlation, indeed the sign and its magnitude. So what I've done here is the following. To address this issue, I divided up the period between October 2007 and July of 2014 into 10 decile ranges in terms of the correlation. So I draw your attention to the fact here that the correlation, this is sort of declining, as you can see. The correlations reached a high of 0.7746 during this period. They were as low as minus 0.5479. I divided the period into these 10 deciles to see what the average value of the scaled intercept, scaled by the implied volatility, was over that period. This is sort of an ex post rate of return. And the point that I infer from this is that as you go to an increasingly negative correlation, that intercept term is increasingly positive, meaning that futures prices have moved up, adjusted for implied volatility, relative to where they began. And so I think this is one of those things that demonstrates, it's not purely monotonic, and I'll admit the statistics haven't been done, so that's good. You have to worry about overlapping observations. So obviously there's some issues here in terms of statistical significance, but at least as a first pass, I submit to you that as the correlation becomes increasingly negative, futures prices have rallied in light of this, above where the stock market has gone over this period. That's what I'm inferring from this. So that's one measure of this issue of the correlation, the sign of the correlation, that the more negative is the correlation, the more you've had a run-up in terms of prices. The other way I'd like to show you this is in terms of looking at something that is a measure of expectations, and we could debate whether this is true expectations or not, but essentially what you're able to do on Bloomberg is to extract what they call a consensus expectation measure. And you have the good people who are doing this. I'm not going to vouch that this is the market's expectation. I'm just giving you this as an indication of the difference between the median expectation of prices and the spot price. And you can see that in the situation right now where we're in a positive correlation, expectation of prices are above the spot, or above the futures, above the futures. And so that's what you would expect in a demand side situation where you expect prices to move up if we get a good outcome in terms of the economy. And this I would like to contrast for you with, and you can imagine what period I took here. The period I took here is obviously the period of the spring of 2011. And so here you'll notice what you're seeing over here. So indeed, prices of futures contracts have built up in light of the geopolitical crisis and way above where the expected price is. So there's some issue about the relevance here, I think, of this correlation. It seems to be related to what is happening in terms of the run-up of prices as well as the expectation of prices going forward. Having done that by way of motivation, let me talk about the model that we like to try to use to extract a forward-looking beta. And so we take the standard regression, a trend relationship, the one-factor relationship between rates of return and the market. We apply the variance operator, and you get equation 5, which has the variance of the futures contract of maturity I, its beta, the variance of the market, and the idiosyncratic variance. And this applies both historically as well as in forward-looking data. And the forward-looking data which we'll use, obviously, is that extracted from option prices. And so what we're going to do is, as you can see in 6 and 7, we're going to lay on a structure on the historical beta as well as the historical idiosyncratic variance, and say that what the market prices of the options are telling you is that the forward-looking one is some perturbation, either multiplicative or additive, relative to the historical. And as I'm sure you've seen, one of the things that you can extract from this is a term structure of equity betas, right? Because you have implied volatility of options going out some distance into the future, liquid ones, say 1.5 years out. So that's one of the things that we get as a byproduct of this. The other thing that you get as a byproduct is something what the market is telling you about future idiosyncratic risk, because you can see in the second equation, you can also see what the model is saying about what option prices are saying about future idiosyncratic risk relative to its historical antecedent, which we can observe. There are a number of issues here which my co-authors and I are struggling on and working on. And that is, what is it that separates the historical from the forward-looking ones, if you wish? What is the difference between the P measure and the Q measure? And so one of the issues that we have to address here are the issue of, the information set that the market is using. Obviously, forward-looking, the market is looking at more than just historical returns. And then there's the difference between P and Q. There's the issue of the market price of volatility risk, which we're thinking about addressing explicitly as well. And obviously, there's been a lot of work on this. So these are some of the issues that are theoretical but impact our empirical work, and which we'll struggle to address a little bit better. Let me show you the results with respect to specific stocks. So there are 8 stocks in Bloomberg's Biz Oil P index. This is an index of oil prices, equities. Obviously, there are a number of these, but this is the 8 that we're looking at. These are the well-known names that we're looking at. We're looking at historical returns, obviously. We're looking at the at-the-money implied volatility. So obviously, there's a volatility skew. We're not addressing the volatility skew in this paper. We're just looking at the money implied volatilities. And so we're looking at these stocks, looking into the future. So those are the 8 equity stocks. And we're also we're going a little further than we're going 24 months into the future on oil futures contracts, because we find implied volatility on these extending out 2 years. There may be an issue of how liquid they are, but at any rate, since we have them, that's how far out we're going in terms of the oil futures contract. And of course, we're using the S&P as the equity market. So with respect to the term structure of equity betas, what I'd like to say here is that you can see that what I've repeated in equation 8 is this relationship between the idiosyncratic variance, beta squared, the market implied volatility, and the idiosyncratic variance. And you can see that if you have a term structure of such implied volatilities, you can sort of link them. And the way we've linked them is in equation 9. So what we're saying is that for each stock, its beta with respect to the market across different maturities is its historical one. So this is whatever the history is, plus an additive and linear factor. We've looked at quadratic as well. So basically what you're doing here is you're linking these options across the different maturities by imposing a structure of how the forward-looking betas relate to the historical ones through this structure that you see here in 9, namely an additive component and a linear correction. And as you might imagine, we simply solve for the minimum residual variance, if you will, on the difference between the left-hand side and the right-hand side of 8. In other words, what are the coefficients alpha that would best explain the term structure of implied volatilities and options that we observe through the inputs into equation 8, the idiosyncratic, the market, and the systematic, or the stock specific, I should say. So let me show you what we get on the linear component on these equity betas. So one has to be a little bit careful in interpreting this because, as I'm sure you realize, the weighted sum of all betas across all stocks has to be equal to 1. That's not going to change for any maturity. But for specific stocks, you can see that if they are sensitive to the economy, their betas might be increasing relative to historical as you come out of the Great Recession and as the correlation, as you saw, turned strongly positive. So that's one inference one can take from this graph. Let me show you what I found interesting with respect to the idiosyncratic variance. And this sort of tells you whether the forward-looking variance on average is smaller. I would submit to you that what you're seeing here is what we should expect when we enter a recession. So as you know, when we enter a recession, correlations tighten and idiosyncratic variance reduces. And so this is sort of what I infer from that, is that what the market's saying looking forward is, look, if we're entering this recession, things are going to move more in tandem. You're going to get a stronger correlation. You're going to get less of idiosyncratic variance. So perhaps some indication of the informational content of what we're doing here. So that's with respect to those 8 equity options, 8 stocks equity options. With respect to the crude oil model, what we're looking at is what I've shown you here, except now, of course, we're looking at different maturities of crude oil futures contract. Again, equation 11 applies. The correction factors here are very similar to what you've seen on the equity side. So namely, what we do is we take the historical, we link the different maturities through an additive and then linear and quadratic correction factor that allows us to link these options across their 24 maturities. We do it additively and multiplicatively. So that's sort of equations 12 and 13 allow us to link these, pooling them together across these 2 years maturity. And here I only have initial results to report. You see there's a lot of noise in these things. So we're trying to really force the data to tell us a lot. I think that there's some lead information here in that the additive correction here does seem to lead the historical as we enter into 2011. So what I'm saying here is that the implied beta is moving before the historical one does, and that hopefully will be able to give us a better sense of what to do about this implied beta, which is what we want to do to see the instantaneous beta that the market is forecasting at any point in time. So clearly there's more to be done, but this is sort of an initial indication that perhaps we can anticipate some hopefully positive results out of this. So to conclude my portion here, what we've attempted to do, as I said, is to combine historical implied volatilities. We've done so both for equity betas in the oil industry, those 8 company stocks, as well as futures contracts. We think it's important to focus on the sign changes in the correlation as the market switches from concern about demand-side issues to supply-side issues. We're seeking to get forward-looking correlations so that we can indeed come up with the forecasted P measure of expected crude oil prices, and I think there's some support to at least looking at the CAPM in this context. My last comment, if I might, is just to say that there's another 2-factor model that we can look at. And notice what I've done here is I've decomposed the equity returns into, or projected them, onto the market and on crude prices. And the reason why that may be advantageous is if you take the variance operator and apply it to the first equation, you get the second equation. And what appears in the second equation is the correlation between the stock market and crude oil. So there may be another way for us to look at this, which is a 2-factor model, and we can tease out or extract this correlation between oil futures and the S&P, and of course contrast it with what we get from our 1-factor model. So with that, Jerome, I return it to you.
Okay, thank you very much, Ehud. So Rashid Brick is going to comment on the paper.
Thank you very much. Today Professor Ronn will not be here, so for some technical reasons I will replace him. For this reason, I will make a simple discussion about Professor Ronn paper, since I couldn't have a chance to read your paper. So I will try to contribute myself to your paper. So to summarize about your paper, it's a really nice paper, because the thing is you have a link, you make a bridge between 2 fields, capital asset pricing theory and the energy market in this paper. In the last year, you have more and more paper about this, but you have to know that the energy market are really important in the economy for the geopolitical reason. When you have a change on the price of oil or the gold, you have an impact on the equity market and other markets. So that is a very nice study, especially with what's happened in the last years. So it's a really nice paper for this reason. Another reason that you have made a very high contribution about your equation, which link the expected of the future prices and the term structure of the term structure, using only correlation and the implied quality, which through the market price of risk, which is really nice, and it's easy to interpret the risk when you see, for example, what happened with the revolution in 2011 with this simple equation. So my question is, do you think it's possible to extend your work using some vector auto regressive models? Because the thing you have, as you know, the oil market, you have some high correlation to 20 days, something like this. So maybe it's better to have a fine model to explain some and to have less noises, and also to make a trend which is followed by this autocorrelation property. So that was my only question.
Very good. Thank you very much, Rashid. Would you like to respond to this comment?
Yes, thank you, Jerome, and thank you, Rashid, for stepping in. I know this was a last-minute thing. Should I thank Rashid again? Or... Anyway, thank you, Rashid, for stepping in. I know this was a last-minute thing, so I commend you on doing that. I appreciate that. The other factor that we've looked at is indeed stochastic volatility. So you can see that that's something with which we might be concerned, and we're sort of thinking of integrating that explicitly, since, as we said earlier, I think that might be an important one in terms of explaining the issue of the P measure expected value relative to the futures contract. The last thing I would like to say in response, the issue of emerging market is obviously one that's been very important the last couple of years. At this point in time, Rashid, I think what we're going to do is stick with the S&P as reflecting that in itself. So I think it's fair to say, at least anecdotally, the S&P is indeed sensitive to what's happening, in particular to the Far East, and so we're assuming that that's going to be reflected in that. But your issue on the second factor is a very well taken one.
Other questions or comments from the audience? I have a question actually about the coefficients relating the historical and prospective betas and sigma. So these are basically stochastic processes, yeah, right? I mean, so the alpha and the A and so on. Is there any structure that we can extract from the empirical results that you obtained?
That's a very good point, Jerome. I think that one of the trade-offs that we have to make, as I think implicitly is in your comment, is whether to fix these over some time period. At least that's one of the trade-offs. Fix it over some time period and extract the constant one. What we're doing here is a little bit of a concession to what real-world people do, and that is a daily recalibration. And I realize daily recalibrations are subject to intertemporal consistency issues. I think the appeal of a daily recalibration to us is that you get a snapshot each day of what the market is thinking about the future. And so that is indeed a trade-off that we have to make. As I said, one of the things we are looking at is sort of a modeling of stochastic involved too. But your points, I'll take.
Great. Other questions or comments?
This is, I really like this approach of forward-looking betas, right? And I thought about it years ago, and I didn't even know how to start. So I appreciate this, your contribution. So what are these papers doing in the equity? They're on the, so for equities, right?
Yes.
How difficult is it, or what is easier? If I had to compare the approaches, where are the wrinkles in, let's say, commodities or energy, as opposed to equity, where you have more liquidity, perhaps, and have options as well?
Okay, so let me start on the last one, Alvaro. We're not dealing with the liquidity issue per se. We're assuming that what we observe is what we have, and so your point there is well taken. What Chang, Christofferson, Jacobs, and Weinberg have done is they've done a forward-looking beta on equities, looking at, as you can see, the volatility skewed. So their inferences from there, we're sort of looking at historical and then seeing what perturbations we should apply to it. But that's a good paper, and I commend you to look at that and see if you like that approach as well.
Very good. Thank you very much. So this basically concludes the session on energy. I would like to thank all the speakers, discussants, as well as the audience for their questions.